So, we were at the, if I remember, secondary markets. And in the secondary markets, we had sales, as in loan sales. In this particular case will be mortgage sales. That was the one. And number two was securitizations. On sales, I'll repeat some key characteristics were correspondent banking. And I was just reading this morning that it goes both ways. It could be the bigger bank selling loans to a smaller bank, or it could be the smaller bank selling mortgages to the big bank. It goes both ways. It doesn't go just one way, okay? So that was number one. Number two was, again, the same red color, with and without recourse. Says whether the seller has a liability with recourse or no liability if the mortgage defaults. That was number two. Next one was that when you sell the mortgage, you remove the asset from the balance sheet, you remove the liability from the balance sheet. So you reduce balance sheet, reduce the balance sheet. We say that the financial institution becomes lean. The opposite of lean is fat, as in bloated, okay? Usually bloated financial institutions. What's the problem? Okay, where is the attendance? Usually bloated financial institutions get in trouble, just like a fat person eventually gets in trouble with health. Now, the trouble as with financial institution usually comes 10, 15, 20 years down the road. Doesn't come immediately. So when a financial institution gets bloated, trouble comes a decade or 2 decades later. Like when a person gets fat, you don't get diabetes tomorrow morning. It takes 20 years to develop diabetes. Okay, so it makes the institution leaner. Okay, we did that. That was the easy one. Now we get to the difficult part. Securitization. This is the long, difficult, and one of the harder parts in finance in general. All right, so we're gonna struggle through 3 major forms of securitization. For those with a textbook, that's page 202, okay? Page 202 at the very bottom of the page. Number 1, pass through. Pass through securities. Number 2. Anyone? Anyone? We got a lot of visitors. They just sit and relax. Number 8. Can anyone read on page 202 at the bottom? Okay, wow, that was amazing. CMO, standing for collateralized mortgage, let's see, obligation. Number 3. What is number 3?
Mortgage backed.
Mortgage backed. Now I'll write it as mortgage backed security because there are many different types of mortgage backed securities. So it is a general term, and the one more common will be mortgage-backed bond. Mortgage-backed bond. All right, let's go through these. Let's see. So, what is securitization? I already explained it before. You get a, let's say like this. You get, let's say, 100 mortgages. Mortgage 1, mortgage 2, mortgage 3, mortgage 4, okay? Mortgage 5, and all the way to mortgage 100, okay? And then you get a slice. You get a little slice of this. You get a little slice of this. So, if it's a mortgage-backed bond, a typical slice will be of $1,000. If the whole thing is $1 million, they're going to be 1,000 slices of $1,000 each. Maybe a typical one will have $1 billion, and there may be millions of slices. And everybody takes as many as they want, kind of like in a pizza shop. I want 2 slices, I want 20 slices. Okay, let's see. Pass through. Number 1. Okay, that's on the next page. Pass-through security is fairly straightforward. You pool all the mortgages, meaning you put them together, and then all you do is, meaning the financial institution, will pass the payments to the buyers. That's all there is to it. All you're doing is become an intermediary. That's all, just a simple intermediary. So, the pass-through security represents fractional ownership of the original. So, maybe you own only 1/1,000,000th of every mortgage. If they pay the mortgage, you collect. If they don't pay the mortgage, you don't collect. That's all there is to it. Let's see what else we have. it will have what's called a servicer. Servicer. A servicer stands short for a service company. It is a financial institution which specializes in collecting the payments from the borrowers, the mortgage payments from the borrowers, and then sends the payments to the buyers. You see, you're going to have thousands of mortgages in just one single security. And then you may have hundreds or possibly thousands of buyers in one particular security. So we're going to have thousands of payments coming in. This is the servicer. You got thousands and thousands of payments coming in. And then you're going to have only for one security maybe hundreds or many hundreds of buyers. Then for a second security, hundreds and hundreds of buyers. And maybe for a third security, there are going to be thousands of buyers, depending how big the whole security is. Now, when I say security, I mean the big pool. The pool will be sliced into thousands of securities, or it will be sliced into millions of securities. So they're going to be sliced into millions of security and have 20 securities. A big fund will have 1,000 securities, another one will have 50 securities. So there's going to be a lot of processing here. And the name of the game is called service fee. It's all about the fee, collecting the money. So service fee is kind of like a percentage, let's say 1% of all the mortgage payments. As long as the borrower, mortgage borrower, makes a payment, the borrower technically makes the payment to the servicer. The servicer will pocket 1% as part of the contract and will pass through the other 99 to the corresponding buyers, okay? So he will keep track of the buyers' addresses, of their bank accounts, of methods of payments, okay? And he may be making tens of thousands of payments in a single month. It's a big business, okay? All right, let's see what else we got. We call these, sometimes these are called third-party servicers. Third-party servicers. Third-party services are not associated with the original financial institution which originated the loan, is not associated with the buyer, is just an independent business which specializes in servicing mortgages, okay? Because it's a highly specialized business. Again, you got to keep track of tens of thousands of mortgage borrowers with their address and payments and everything else. Maybe tens of thousands of buyers, and you got to be able to keep track of everything. And of course, for everything you make a payment. So small mistakes can result in tens of thousands or millions of dollars of losses. Okay, so what do we have here? Originally, this market started as government sponsored. So let's write this big thing. That's big in the United States. I don't want to go into a great detail because this is specific only for the United States, only for the US market. But you need to understand the general concept. The general concept is of a GSE standing for government sponsored entity. And if I remember, there were three major ones. Let's write them out. Ginnie Mae, the second one will be Fannie Mae, and the third one is Freddie Mac. Well, we can even write it like Freddie Mac. There's a long name, FHLMC. FHLMC. Well, you don't need to remember these names or details, not expected about it. Okay, let me see. So what's a GSE? Government-sponsored entity is a private institution for profit, sponsored or established by the U.S. government, or in general, a government. Okay, you may have one here, and in Europe we also have our own. Every government will establish its own financial institution, and for the purpose of, in these particular institutions, for the purpose of creating or generating mortgages, for the purpose of stimulating the real estate market, the real estate business. And the market goes in the construction end, it goes into the buyer end, and it goes into the lender end by securitizing them further. And the whole idea is, in the thinking of governments, which of course is totally and completely wrong, but that's how governments, bureaucrats think, is that if we can boost the real estate market, and the real estate market starts working better, and we can do more construction and more selling, that this will boost the economy, okay? And that's how they think. And this is exactly true, as in doing a nice shot of heroin, cocaine, or something, some other narcotic, which will boost temporarily your strength, your power, your endurance, your resilience, but eventually will ruin your health. And it's the same thing that's happening with the real estate. Usually, these type of loans act as drugs on the economy. Temporarily, they give power, they provide energy. In this case, it's going to be credit energy, okay? It is a true, genuine drug. And when the effect of the drug wears off, things go bad. And you gotta keep doing the drugs, and there's one problem with them, exactly as with credit. In order to keep the economy growing and going, you need more and more credit, which is the same as more and more drugs. Eventually, you overdose. And when you overdose, the crash comes and the banking system collapses. And these institutions have done it over and over again in the last 6 or 7 decades so far. But that's how government bureaucrats think. It's like a nice quick shot, and it makes you feel good for a couple of months or a couple of years, and down the road it's going to be someone else's politician's responsibility to clean the mess, okay? It's kind of like the drug dealer sells the drug, okay, got a customer, and then they got a whole hospital to deal with the drug addicts later, maybe 3 years, maybe 20 years down the road, okay? It's the same thing. Let's see what we have here now. Okay, these institutions provide some important characteristics. These are associated with the pass-through securities in general. Number one is the general concept of timing. insurance. Timing insurance means the following. It means that mortgage borrower may make his payment on the 1st or on the 2nd or maybe on the 5th. He may be 3 days early on the payment. He may be 5 days late on the payment, okay? So, mortgage payments arrive in uncertain dates, okay? Sometimes you gotta pay on the 1st, but you get your salary on the 1st. You can't pay on the 1st, you can pay on the 2nd, maybe pay on the 3rd, okay? Maybe on the 5th, okay? So, maybe you don't get your salary on the 1st, it's a Saturday and Sunday, you get your salary on the 3rd, okay? And by the time you make the payment, it's the 6th. So, what timing insurance means is that the financial institution like Ginnie Mae, Fannie Mae, and Freddie Mac, which issued these pass-through securities, they will guarantee the timing of the payment. If you're the pension fund or the mutual fund or the bank or the corporation, whoever is buying the security, you're guaranteed by this particular institution that you're going to get your mortgage payment on that particular security, on that particular date. You're going to get your payment on the 2nd, no matter what. On the 2nd, the payment is in the bank, okay, in your account. So, timing insurance is associated with the uncertainty of arrival of the mortgage payments, could be 2, 3, 5, 7, 12 days, and the relative certainty of payment on the mortgage-backed securities in general, the pass-through securities in general. So that's the timing insurance. If you bought that pass-through security, you get your payment on the 3rd every month, guaranteed. Okay? Guaranteed by a major, these are huge, especially Fannie Mae is a huge financial institution that is, we say, government sponsored or government backed by the US government. So timing insurance is an important financial service which they provide, okay, on top of all the payments and other stuff. So that's number one. So it acts as a payment timing guarantor. They guarantee the timing of the payment. Let's see. The standard denomination for these securities, they say, at least for some of them, are $25,000. This gives you a nice, beautiful, round number to work with. You get 2 securities, it's $50,000. You get 4 securities, it's $100,000. Of course, you get 40, and that's a cool million, okay? So, it's a nice, beautiful, round number to work with. Also, you get a nice, clear interest rate. You understand what the interest rate is, okay? So, all of these are these securities over here. Of course, when these institutions make these pass-through securities, they collect the money, and then they send it over. They collect a little bit of a spread, which is their profit. They kind of like act, but it's not exactly a service fee. Let's see. So the mortgages themselves are the collateral. So the mortgage collateral. So these pass-through securities will be backed by the mortgages. If something goes wrong, you can at least take the mortgage if you're a buyer. When you take the mortgage, either the mortgage borrower will pay you or you will take the property of the borrower, okay? So there is some collateral. The collateral is first the mortgage itself, but if the mortgage doesn't pay, it's the real estate property. That's the collateral of the mortgage. Now, this is a very important fundamental concept in finance and in law. It's not in the textbook. It's called collateral chain. Collateral chain means that asset A backs or serves as a collateral to asset B. Asset B serves as a collateral to asset C. Asset C serves as a collateral to asset D, and the collateral chain could be fairly large, okay? Could be fairly long, okay? And as long as the collateral chain is solid, everything appears okay. A collateral chain represents phenomenal financial risk because anywhere that the collateral chain breaks, all the parts in the chain break, okay? So, that's where the problem in general is. All right, so the collateral chain, in this case, you got the mortgage-backed security, which is backed by the mortgage, and the mortgage is backed by the real estate, okay? All right, let's see what else we got. So that's the one, let's see, on Fannie Mae. These are known government sponsored to have what's called implicit backing. Implicit government guarantee. Implicit means that the government did not specify in a law, the government doesn't claim to have a true responsibility, to make a true guarantee. But implicit means that everybody knows and everybody understands that if Fannie Mae or Ginnie Mae get in trouble, the government will save them. The government will bail them out. Everyone is expecting to do that. Because if Fannie Mae goes bankrupt or goes down, this means that the whole mortgage market crashes. And if the whole mortgage market crashes, it means that the real estate market crashes. And if the real estate market crashes, it means the whole US economy crashes. And if the economy crashes, it means stock markets, bond markets, anything else will in return crash. It could easily lead to a US and a global depression. So the consequences could be so devastating that they say, oh, no matter what, the US government will save them or bail them out or will support them in one way or another. Because the consequences could be horrifying, okay, to the whole world. And that's why the guarantee, even though it's not in the law, it's basically implicit. Everybody understands that that's what's going to happen anyway. Yes?
Considering that Fannie Mae will implicitly bail out by the government, it would allow them to offer more riskier mortgage-backed securities.
Who is it? Who is it? You?
Fannie Mae.
Again?
Yes.
Fannie Mae what? Repeat?
Because they
No, repeat the question. What's the question? I did not hear the question.
Fannie Mae is implicitly can be bailed out by the government.
Oh, yes, it's implicitly guaranteed. Whenever they get in trouble, the government bails them out.
Wouldn't that allow them to offer riskier things in their business?
Yes, that's the cause. Yes, correct. Correct. That's answering your question. Let's write it out here. This is exactly how it works. It's called in finance, in banking, in economics, it's called moral hazard. Moral hazard means that if you know that the government's going to bail you out, you can make more loans and you can make bad loans, and there are little or no consequences to bad behavior. Doesn't matter how bad the loans are, you're going to get bailed out by the government. That's exactly why these institutions, when they go bankrupt, they go horribly bankrupt, okay? Because they run for a long time, and for a long time, they accumulate phenomenal, huge losses. Now, when another bank begins to accumulate losses, the market will not finance it. Market credit will stop, and the bank financial institution cannot expand more credit. But these can continue to expand credit because for them it's easy to borrow because there is an implicit guarantee. So the short answer is yes, absolutely. That's exactly the wrong role of the government. It's the equivalent of this. We'll guarantee, the university or me will guarantee that everybody gets A in this class. Wouldn't it be great, right? We had this discussion before in another class. Wouldn't it be great to have everybody A, right? Hey, you guarantee A. You can come to class, don't have to come to class. You can study, don't have to study, right? It doesn't matter, okay? The result will be most people won't be coming, or if they'll be coming to class, they'll be playing with Facebook, not paying much attention, or they won't be studying after that. It will be a disaster to guarantee everybody top grades. Well, this is exactly what it is. In life, when things are guaranteed, there's usually no incentive to do the hard work, to do the right work, to do what's proper. So, that's the way it goes. Let's see what else we got. Fannie Mae creates number 3. Fannie Mae specializes a lot and creates mortgage-backed bonds or mortgage-backed securities. Okay. Now, when a mortgage-backed security is done, let me see what I have for pass-throughs over here to make sure what else we got here. All right, let's try to do this. These mortgages in general associated with these financial institutions, I was teaching last time, we call conventional mortgages. For most conventional mortgages, we have what is known as collateral ratio. And the collateral ratio is the ratio of the collateral to the loan. Okay. Now, I had here, one of my friends had this particular experience where they got a motorcycle which is worth, let's say, $1,000. Okay. And if it's worth $1,000, you can go and you can borrow. How much can you borrow against a motorcycle that has a value and could be sold for $1,000? How much can you borrow here locally, somewhere in the city? How much can you borrow? How much? You can borrow $3,000? What do you mean you don't know? Can you borrow $5,000? No? I mean, who's stupid enough to give you $5,000 loan against a motorcycle that's worth $1,000? Will they give you $2,000 loan? No. Will they give you $900? No way. No way. Okay, let's call these. Okay. These are people that don't give $900 for $1,000. How are they going to live? You know, if you don't pay, what, they keep the motorcycle? Right? No. It doesn't work like that in the real world. Okay, we call these here, we call these loan sharks. A loan shark will have a collateral ratio at worst 200%. Here, the typical ratio is 400%. What does it mean, 400%? How much you can borrow on a motorcycle worth $1,000. 250. You want to borrow? The best you can get is 200. Oh, well, typically you'll get 250. The most you could possibly get is 500. Okay. This gives you an incentive not to lose your motorcycle. You're going to be next month coming with the payment, because if you don't come with a $250 payment, you're going to lose a $1,000 motorcycle. That's a huge loss for you. So this collateral ratio, high ratio makes incentive to pay. Low ratio makes incentive not to pay. Now, here in Phnom Penh, the ratios run 300–400%. Now, in the mortgage market, the standard conventional requirement is 125%. Okay. This collateral ratio is the exact opposite. The exact opposite of loan to value. Loan to value ratio. Loan to value ratio, which is exactly what it says. It's the loan to the value. The value of the collateral. And the loan to value ratio is limited to 80%. So if your house is worth $100,000, you can borrow at most 80. Okay? And your collateral ratio will be 100/80, which is equal to, how much is 100/80? 125. 125%. So you can think in terms of collateral ratios of 125 and more, or you can think in terms of loan to value ratio of 80% or less. So conventional mortgages require a minimum of 125 collateral or a maximum of 80%. This makes the lender feel secure with his collateral. Okay, let's see what else. Okay, these securities will have ratings. So these securities will be ratings. So they'll have rating, okay? We call this, let me rewrite, credit rating. Credit rating. These securities will have a credit rating. And the credit rating will be related to the financial institution which issues the security. So if Fannie Mae has a top credit rating, its securities will also be top rated, okay? If it has a medium rating, it will be medium rating, okay? So the credit rating by the security is inherited from the credit rating of the financial institution in general, okay? So that's the next one. Let's see what else we got. So these are conventional. You can also have, okay, I can delete this part over here. So, the market for securitization is divided into number one, GSE, Fannie Mae, Freddie Freddie Mac, whatever else we got, Ginnie Mae. And the other one is called, that's on page 205, private label. Private label securities. Private label securities are securities issued, mortgage-backed securities issued or securitized by private financial institutions. The typical private financial institutions, we call these private conduit. Private conduit is a private conduit means channel. So it's going to be a private institution. Most commonly will be an investment bank. Lehman Brothers did a lot of this. They went bankrupt. Bear Stearns did a lot of this. They went bankrupt. Goldman Sachs did a lot of this. They went bankrupt, but the government bailed them out, okay? So, all of them do. Now, they give you a list over here. Prudential Home Residential Funding, GE Capital Mortgage, Chase Mortgage Finance, Citigroup. So, these are different banks, different financial institutions, which will issue mortgages, then they'll package them in and securitize them and sell some sort of a mortgage-backed security in general. Could be a pass-through security, it could be one of the other types of securities, mortgage-backed bond, and they'll sell it to investors. So these could be private label. Any financial institution in a free market could possibly do that. Let's see what else we got.
Sir,
Yes?
this private label will be the servicer for the collection data.
No, not necessarily. Not necessarily. Again, that's why we use the word third-party servicer. So they could potentially be the servicer themselves, and they'll have a servicing department, or they may have a third-party servicer. If you're Goldman Sachs or a major investment bank, you don't want to deal with processing thousands or tens of thousands of checks, collecting and all the other stuff. Now, you know, if you're an investment banker, you don't deal with these little things, you know. You deal with the big deals. You make a deal worth $1 billion or $2 billion. And when the deal is worth $1 billion, you put in your pocket 10 or 20 million out of one deal. You don't want to deal with these payments, and they don't want to deal with it. They leave it to other businesses to do that, okay? But that's not as important as understanding that those that issue these securities are private businesses, okay? So the company that's arranging these securities, the private conduit, is called a sponsor. So the sponsor is the financial institution that makes the securitization process. So the sponsor will technically purchase tens of thousands of mortgages. They will pool the mortgages together. They will structure the payments and everything else. They will structure the new securities, and then they will sell those securities to investors. So that will be the sponsor. And now, answering his question back again, the servicer may be the same as the sponsor, or the servicer could be a completely different institution. In other words, the servicing could be outsourced by the sponsor to a third-party servicing company, which specializes in mortgage servicing. All right, let's see what else we got over here. Okay, I discussed in 2006 the implicit guarantee. Now, the implicit guarantee has an important consequence. If people believe there is an implicit guarantee, people believe that these mortgage securities are lower risk because it's, guaranteed by the government if things go wrong. So these GSEs, Fannie Mae, Ginnie Mae, and Freddie Mac, can, because people believe they're guaranteed, can have cheaper borrowing. Cheap. Borrowing. So, if you are a financial institution, you may be able to borrow at 4%, but with the implicit government guarantee, you can borrow at 2 or 3%, okay? Because it's considered to be lower risk. Well, now what does it mean, cheaper borrowing? Means that they have a competitive advantage. Hey, you can borrow at 4, but I can borrow at 3. I can make better profit. I can provide better loans. I can make better security. So we call this, and this is what it is, it's an unfair competitive advantage. It is competitive advantage not because they're competitive, not because they're better, not because they provide better service to better. It's just because they're guaranteed by the government. Unfair competitive advantage. Okay? Unfair competitive advantage due to the major government guarantee. Which means that when you have unfair competitive advantage, you can grow faster than the competitive market. Okay, so now these guys in boom times can grow faster and make more bad loans in general. Let's see what we have. I have a little section here so I can finish. Okay, page 2007 for you is on the second paragraph, is the discussion of the moral hazard. The second paragraph in 2007, how all of this is the discussion of your question, the moral hazard, and how moral hazard, let me see where I wrote the moral hazard part. I can't see the moral hazard part. Let's see, where's the guarantee? Implicit moral hazard. Okay, so that's the next important, meaning the last important concept is because there is a moral hazard, the government says, we gotta supervise. There is a government regulators. So, it works like this. Just 2 more minutes, okay, so I can finish. This is very important to understand because that's the nature of the beast. You need to understand the nature of financial market. When the government creates an institution which has moral hazard, meaning an institution that's designed to work very badly and very poorly because it doesn't have incentives to work well and properly, then the government, after the institution works for a while and everybody sees that it's poorly run, the government designates a regulator. The regulator to regulate and watch over the institution, okay? But there's one little problem. The regulator does have an incentive to do the right thing. So who's going to watch whether the regulator is doing a good job? So, as bad as the financial institutions are, the regulators are even worse. The regulators don't do a good job. So, what happens is, and that's part of the game over there, as one regulator fails, like HUD, Housing and Urban Development, the government says, this regulator is no good. They create a second regulator. And of course, when the second regulator fails, they create a third regulator. So usually you have a whole bunch of regulators hoping and praying that one of them will work properly. But none of them works properly because they're all government institutions, all subject to that evil called corruption. And we need to discuss somebody, maybe you'll remind me the next time to discuss an important concept of corruption called camera, Miss Layton? Revolving door. Have you studied what's a revolving door? Revolving door means if you're a regulator, you're supposed to watch for these financial institutions. You don't watch for them. When you finish your job, you get in the government, you go to these financial institutions and they give you a big salary. I'll discuss it maybe next time. All right, so I'm up to page 2,207. All right.